Did you know you can receive an interest rate 3% below the market rate just by asking the seller of the home you're buying to give you a credit toward your purchase? Brand the Mortgage Man here, and if you're in the market to purchase a home but are scared to make the jump because interest rates are high and the resulting payment is more than you can afford, you'll want to listen to what I have to say. I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. It's with this experience that I'm going to show you the advantages of using a temporary rate buy-down strategy to save thousands of dollars in your first years of ownership while making the transition into your new home more affordable. I'm going to teach you the difference between a price reduction and a 3, 2, and 1 year rate buy-down while sharing my approach to getting a seller to cover the cost for you. So let's start by looking at what a price reduction would do to your monthly payment. And then we'll compare that to what a 1 year rate buy down, a 2 year rate buy down, and a 3 year rate buy down would save you in monthly payments and what the cost of that would be. So let's start by looking here at a $500,000 purchase with putting down 3.5%. So you're doing an FHA mortgage on a $500,000 property in this example. So you see here we have a $500,000 property worth $500,000. You're putting down 3.5%, which is $17,500. Your loan amount's $482,500, which is 96.5% of the $500,000. Like I said, we're going FHA. Now, let's just say the market rate, or the rate you qualify for right now, is 6.75% for a 30-year fixed rate, as you can see right here. The resulting principal and interest payment is $3,184.25 every single month. Now, right now, in this market, homes are selling for roughly 3% below what the asking price is. So let's look at how much the monthly payment would decrease if you were to receive a 3% credit from the seller. Now, FHA mortgages actually allow you to receive up to 6% in seller concessions. But for this example, let's just use the 3%. So 3% of $500,000 is $15,000. So we're going to reduce the purchase price from $500,000 to $485,000. That's a $15,000 reduction. The resulting payment becomes $3,088. As we said before, at $500,000, the payment is $3,184. So it's roughly $100 less per month by reducing the purchase price by $15,000. Now, that sounds great, right? But is $100 really going to help you make the decision to buy the home now versus waiting to buy, right? Because that's the situation for most people, right? They're waiting for rates to come down, or they're waiting for prices to come down, which is very unlikely because when rates come down, prices will typically go up. So if you're waiting for rates to go down and prices to come down, it's probably not going to happen. Will rates eventually come down in the future? Sure. Prices? Probably not likely. So that's what it looks like if you were to get the price reduced by $15,000. I don't recommend doing that if you're trying to get a more affordable payment. A better way to utilize that money that would have gone toward a price reduction is going to be used toward a temporary interest rate buy down. This is where the interest rate is reduced for a set period of time. So it's not reduced for the entire length of the loan, right? Because your goal may be to refinance when rates eventually drop, as it is for most people who are buying a home right now. But you need some reprieve in the short term. You need something that's going to keep your payment lower for the initial 1, 2, or 3 years that you're going to own this property until you get to a point where you can refinance because rates have come down enough to make it advantageous to do so. So let's look at what the numbers look like with the buy down scenarios. So we'll look at the first scenario, a 1 year buy down. So a 1 year buy down means that you're reducing the rate by 1% for the first year of ownership. Now we talked about a price reduction that was going to reduce the payment by $100, right? So let's look at reducing the rate to 5.75% from 6.75% with a 1 year rate buy down. That reduces the payment to $2,865 per month, right? So we said before that the monthly payment at 6.75, just to reiterate, is $3,184. We're talking about a difference in payment of about $300 per month with a 1 year rate buy down. Now, what does a 1 year rate buy down actually cost to receive? Well, we can easily figure that out here. So a 1 year rate buy down would cost the seller, because you want to have the seller pay for this, right? To really see the benefit of the buy down, you need the seller to pay for that buy down. And I'm going to talk about how to negotiate to get the seller to pay for that. But If we're going to use the buy down strategy, then you're going to be reducing your payment, and it's going to cost about $3,600 to do that, right? The amount it's going to cost for the temporary rate buy down is going to be equal to your savings. So if you're saving $300 a month, you multiply that by 12, which is the time period that the rate's reduced, and you're saving that money, and that's the cost. So the cost is equal to the savings. And that's why it's important, and we're going to talk about this a little bit more, it's important that the seller gives you a credit to cover this for you, right? Now, we talked about the seller giving $15,000 off the price. So $3,600 is a fraction of that, right? So a 1 year buy down isn't going to be the route you want to go. You have other alternatives, though. You can do a 1-1 buy down. With a 1-1 buy down, the rate is actually reduced for the first 2 years of ownership by 1%. So 1% the first year, 1% the second year. So rather than you just saving $300 a month for the first year, you're going to save $300 a month for the first 24 months, the first 2 years. That means it's going to cost double what it would cost for the 1 year buy down, right? So if it was $3,600 for a 1 year buy down in this scenario, it's $7,200 for the 1-1 buy down, right? Which is going to reduce your rate for the first 2 years. Now, what we also want to compare this to, because we have more money left over, right, is we want to compare this to other buy downs. So a 2-1 buy down. A 2-1 buy down is going to reduce your rate by 2% the first year, 1% the second year. And you're going to see substantial savings by doing so. So 2% lower than a 6.75 would be, and let's just read one more time, $3,184 is your principal and interest payment, is 4.75. That would drop your principal and interest payment to $2,561 per month. That's almost a $600, what is that actually? Yeah, $600 a month less than what you'd be paying on a 30-year mortgage at 6.75% interest. That is substantial, right? A $100 savings is good, as we talked about on the price reduction. $500 or $600 is going to be substantial. That's your first year. Second year, you're going to be saving $300 a month, like we talked about, right? Because you're going to be reducing your payment by 1% for the second year. So it was 2% the first year, 1% the second year. And the last option when it comes to these buy downs is a 3-year buy down, which is 3% lower the first year, 2% lower the second year, 1% lower the third year. Just to show you what that would look like, if your rate's at 3.75% for your first year of ownership, your principal and interest payment drops to $2,273 per month. That's almost a $1,000 difference in your monthly payment in your first year of ownership. $1,000 is very substantial. And what you would do is, rather than getting a $15,000 price reduction, as we talked about, you would get that $15,000 in the form of a seller credit that you would then use to purchase a 3-2-1 buy down. Technically, the seller is covering that cost for you. Now, what's nice about a 3-2-1 buy down, other than the fact that it reduces your monthly payments for a set period of time, is that, let's say rates do drop in the next 12 months. Well, any money that the seller gave you toward that 3-year buy down in this example that has not been used yet belongs to you. So when you go to refinance, you actually get refunded the unused portion of the credit they gave you for the temporary rate buy down. So you're not losing the money, which is nice, right? They gave you the credit, that money belongs to you. You get the full benefit of that credit, either in the form of the bought down interest rate for the period of time, if you happen to go through the full, 3 years, 2 years, or 1 year, whatever it might be. Or if you refinance within that time period, you get the difference of what's left back to use toward your refinance. It can go toward your closing costs on the refinance. It can go toward paying down your balance on your loan when you refinance. But the long story short, is that money still belongs to you. You don't lose that money. So this is a great strategy to make homeownership more affordable for you. If, as I said before, the rates and the monthly payment are what's keeping you from getting off the fence and purchasing now. So by understanding how to utilize these buy down strategies, you'll save thousands of dollars on the purchase of your new home and help in making your decision to buy a home now versus renting or staying in your existing home that might have a low interest rate on it. Make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.